Yeah, let me just say it's great to see so many of you that really have been coming to these meetings since the very beginning. And I think that's been a real strength of AMIS, has been the friendships and trust and everything else that's developed out of this process. Abby asked me to do a brief overview of the macroeconomic conditions surrounding the global, a lot of these, the agricultural markets. And I'm going to give a very brief presentation talking about some of these trends that we've seen. Not surprising, a lot of these commodity markets have shown very similar movements over the last several years. And in particular, if you look at the lower prices that we've seen in the agricultural markets, as evidenced by the FAO food price index, for most commodities have come down considerably from 2012. You do see that in a lot of the other markets. Now, what I'm going to talk about, and while these markets like energy markets and food markets have been very closely related over the years, I am going to talk a little about the differences, and I think that's important too, that each are driven by their own fundamentals as well. And although there are a lot of interlinkages, the individual fundamentals are important to consider as well. First, let's start by looking at the macro projections, and these are the most recent projections by the IMF in terms of world output. And I think the fundamental thing is that the world economy is not growing as fast as people had anticipated. And even compared to the July IMF forecasts, the world economy is projected now at 3.1%, and that's down 0.2% from just where they were in July. Similarly, for 2016, a little bit of improvement at 3.6% for the world, but again, down from what they were considering back in July at 3.8%. And then if you obviously go to several countries, you see the variety of growth patterns as evidenced on this chart. Certainly, if you look at countries like Brazil and Russia that have actually seen their economies are projected to contract a bit this year. Flat growth in countries like Japan, Canada at 1%, the EU at about 1.5% growth for next year, and even the US, which is projected to grow at around 2.6%. That's seen as one of the bright spots in the world economy, which just says how for the time being, the growth rates are still just a lot lower than what people had anticipated from the recovery. And again, with the exceptions have been, of course, China and India and some of the developing countries, but even there, China growth rates have slowed as well. Now, if you look at the role of China in the world economy, and this is something that, of course, has been projected for some time now, continues to be seen as growing and as being the large engine of growth, as we move forward. But even there, just looking at the projected growth rates, you can see the adjustments downward that IMF has made, at least over the last couple of years. So even the countries that were providing such real strong growth for the world, like China, those growth rates have slowed. And what that's meant is things like trade volumes aren't quite as high as what we had anticipated a year ago. And when you see the trade volumes contract a bit, again, not contracting in the sense of falling from where they were a year ago, but rather contracting from what the projected volumes had been. That means overall slowdown in manufacturing and other things, which means you're using less inputs like oil, using less inputs like metals, less so commodities or food commodities. I think that for the most part, food tends to be pretty, in the short run at least, pretty income inelastic. That is very small changes relative to changes in income. So, for example, if we look at soybean imports by China, those continue to be very, very strong. Some of the drivers that we've seen in commodity markets. But there's no question on a lot of the other ones like oil and metals and other things, we have seen some contraction. And so if you look at commodity co-movements, you can see that for many of these commodities, we've seen lower prices, or prices have trended down. Now again, agriculture, that's trended down from 2012. You can see things like the differences, though, are very stark here. You look at oil, where that really started to crash at the end of last year, but now down as well. But again, a lot of these major commodities moving, again, reflecting the slowdown, I think, in the global economy, and the fact that for a lot of these commodities, what that has meant, and I think here, or commodity groups, I think here agriculture would be part of this in particular, is the fact that supplies have grown relative to demand, and because of that, increasing stocks and lower prices. Here, just the story on oil, again, less demand for oil, and the fact that you have places like the U.S. where, because of fracking and other things, the supplies of oil have increased such that you see that fuel stocks have grown considerably over the last 12 months, and that has very much contributed to the low prices that we've seen in world markets, with oil prices now below $50, where just a year or so ago we would have been looking at $100 oil. Similarly, the other energy stocks, things like natural gas prices, they too have been flat. This is, of course, these are U.S. prices, and the U.S. market, of course, has seen this big increase in natural gas supplies, so those inventories of natural gas have risen as well. That's good news for producers in one sense, because one, agriculture is a big consumer of energy, both in the form of direct energy like petrol and diesel fuel. In the U.S., U.S. farmers use a lot of natural gas, both directly for things like drying grain, but also indirectly, obviously, through things like fertilizer prices, and particularly for urea and the nitrogen-based fertilizers, where we've seen a decline in prices. And that's good for producers, obviously, and has been helpful. The other major thing that I'll sort of close out with, of course, is when you look at the world economy and look at how, again, how weak many of the countries are, where even with the U.S. only growing at 2.6%, the dollar has appreciated considerably over the last several months. And again, that's after being, because of quantitative easing and other things, after the dollar having having lost a lot of value relative to commodities in the 2009 through 2012 or so, but now starting to strengthen again. And it's interesting, we often look at because of this, and particularly because commodities are still denominated in dollars, you can look at what that actually means. And here I just took a very simple case where I looked at the U.S. Or the price for soybeans in the U.S. in Illinois, and you can see there, that's the blue line, that they've dropped a lot. If you convert that to reals, you can see that the price drop has been somewhat less, and actually has appreciated a bit over time. And all that says, there's two things out of that, is that one, that the drop in prices are affecting countries whose currencies have depreciated versus the dollar. It means that they've helped them a bit, just like they were hurt, by the way, when the dollar was very weak, where they weren't when we saw the big run-up in prices a few years ago, when the dollar was real weak, and we saw a very tight market in grains and oilseeds. There, you could look at the price in reals, and there, Brazil wasn't seeing quite the run-up in prices that, say, the U.S. counterparts were. But it also obviously has some implications for competitiveness vis-a-vis other partners. So I'm going to conclude with that. I think Anne's going to get into a little more of the relationships, at least in the financial markets, on that, and talk about that. But I want to leave you with, I think that we are obviously these commodities are closely tied to one another at one level, but at the other level, I think that they do have their individual fundamentals that are very important. And with that, let me close.